Okay, folks, welcome back. This is our weekend edition of the ICT Mentorship commentary for week ending February 21, 2020. All right, so this is our weekly chart for the dollar index. And as you can see, I have been taking your attention to this volume imbalance in here. And don't be alarmed as to what this red line is. It'll be explained to you in a minute. But for now, just as a reminder, it's the bottom or close of this candle here and the close of this candle. Okay, so all I'm doing is highlighting the range between those two markers. Okay, and then what's the specific point that's being valued here that makes it a volume imbalance is the fact that there's no bodies. It's just the wicks back and forth in here. And it just looks like, if you zoom out a little bit, this would actually first appear as a gap, like an entirely open range, if you just glance at it real quick. And that's usually what happens when I'm looking at charts. My eyes first go to those things, which is an actual gap. Then it goes to a volume imbalance here. Then it goes to a fair value gap. All right, so that's the procedure that my mind goes through when I look at charts. It's the first thing I'm looking for. And then once I go through that, then I go through and look for liquidity pools. Anything above an old high, equal highs. It can be a single high. It doesn't have to be equal, relative equal highs. And the same thing for the lows. It could be a single low or a relative equal low. Our old high here, that is the red line here. That is different from this level back here, which again you'll see when we go into the daily chart. But we didn't get up to the 99.98 level, and we'll see if we do this coming week. It's not important that it does. It's not imperative, really. It just, we look for opportunities for range expansion on this time frame. Okay, the weekly chart. So we're looking for the directional bias for every one of these specific candles. Okay. So what is the heart of this mentorship? Okay, what are we really trying to draw your attention to? You're learning skills to determine what these individual weekly candles are going to do. Okay, folks that have gone through to the charter member level, they will understand that this is exactly what I've been taking you from month one all the way through to draw your understanding of this particular chart. Now, it doesn't matter if we close up or if we close down. What we're anticipating is the expansion that occurs inside of these individual weekly ranges. So we're not necessarily requiring or insisting upon that a weekly candle close up when we are bullish. It could expand up and offer us an opportunity for range expansion to capture our 20, 30, 50, 75 pips, and then still end up closing low on the week and still not change the underlying bias or premise to this particular time frame. Okay, so I just want to put that in there because I got a couple questions for the new members right off the bat, and I kind of want to refocus everyone's attention and remind those individuals that have gone through a lot of content that this is primarily what you're learning. You're learning that. Now, granted, you can take that and run with it in so many different directions, where you can apply it to monthly charts, or you can just say, okay, well, whatever we're doing on this weekly chart, I'm just going to apply that to a daily chart, or I'm going to apply it to a 4-hour chart, and that's going to be my time frame. That's my whole business model for my trading. And there's nothing wrong with that. I'm just saying to have the highest probability for the scenarios, and that's why my strike rate is so high. And when I'm explaining where I think the market's going to go in these commentaries, these levels are accurate, and my ability to see them is so accurate because I'm using this. The weekly chart is what I'm trying to showcase where the momentum and movement and drawing liquidity is going to be, and using all of the things that we teach through each individual monthly content. It's one more building block. Okay, but honestly, I could throw every single one of those monthly lessons on YouTube. Okay, I could put them all on YouTube And none of them would get to the level I'm at because they've watched those videos. Okay. Those videos are pieces. And then the commentaries, like what you're listening to now every Wednesday and weekend, I'm drawing specific lessons of what you should have gleaned from the week's momentum, setups, fulfillment and price and delivery. What you should be retaining, and also sharing the things and concerns that I have before the market trades like this. Okay, so you hear me give my opinion about what I think the market's going to likely do when I have it. If I don't have it, I'm honest and I'll tell you I don't know, and I'm going to have to wait for this or that. But when I do show you my convictions behind a specific bias, I outline why. And then I tell you the other side of the story, whereas it would be me being wrong. What would be those factors, and what would be the catalyst for my idea not panning out? That's not here's a plan A, here's a plan B. Okay. I'm telling you what side of the marketplace I want to be on, and I'm telling you what I would be willing to concede with in terms of being wrong. What would move me to the sidelines? What would kill my trade? What would present more opposition to me getting into a trade? What are those things, those factors? That's what these commentaries do. Okay. All right, so let's move on into the daily time frame. Now, this kind of looks like a weird chart because it's really just giving you a piece of the narrative of what I want to talk about. I zoomed in on around the May 2017 area. All right, so here's that weekly volume imbalance. That's the level here and here. Now, obviously, if I put this chart on Twitter, outside of the mentorship, everybody would be like, well, what's he even putting these lines there for? Oh, he must be thinking that's the bearish order block if it goes up there. You would all have no idea. Okay. The weekly volume imbalance is the black lines. And then what I'm showing here, that red line that was on the weekly chart, I said I would comment on it when we get down to the lower time frame daily. It's the open on that candle. Okay. So while we did get a wick up to that level, no candle body. Plus, we also have the volume imbalance and an actual gap right here. So we had this candle close, and then the next candle opened all the way down here, and it traded up to here. So it left a small little actual gap. But all of this, from this candle's open to this candle's close, that is a volume imbalance. All the way up. Still, even with this wick here, this is still a volume imbalance. So 99.84 is a key level, and also a bearish order block. Then you have a mean threshold, which is the middle of that bearish order block, which is an important level. And then you have the close. So 99.98 mean threshold of the bearish order block, which I don't give a price on here. I want you to do that in your own charts. And then the opening price on this particular candle. When you zoom into this time frame on your daily chart, you'll see it if you're using the trading view. Moving to our regular perspective on the dollar daily chart. Here's the old daily high. As I mentioned, we would look for liquidity above that. And here is that daily bearish order block coupled with a volume imbalance. That's that price level right there, 99.84. Price goes into that, goes into the order block as well. And then we have the rejection. Now, we did not get 99.98. Now, my question to you is this. If you're new, this goes for everyone really, but for the new folks that just came in, or maybe you're in like month 4 or less, is it failure for 99.98 to not be traded to? And let's say dollar just completely collapses and goes down below these lows. Okay, I'm not saying that. I'm just saying, for the sake of argument and discussion, would this be viewed as a failure in analysis? Is this wrong in the sense that the model is broken, the analysis doesn't work? You get what I'm saying, right? Clearly not. Okay, clearly not. We had multiple layers of PD arrays to be watching for in the form of a premium array. We had initially the bearish order block, the mean threshold, the rejection block, which is the highest up close inside of a swing high. Then we had the consequent encroachment of the wick, which is what we learned in recent months in regards to gaps, because I view wicks as a gap, and the tail underneath the candle, that is a gap as well. You won't hear that in books, and I probably just threw off a whole lot of new people with that, but trust me, I teach all that stuff in the commentaries. There isn't a lesson in the content that you go through for 12 months for that lesson. It's actually in the content of the commentaries. So and please don't email me what video is that, because it's your job to go through your study journal, and as I mentioned certain things in particular videos, you need to write down the time marker and what video and what date it was in, so that way you know where to go back and find it. I'm not going to be able to remember everything, because if you can see how many videos I have here, the library is enormous already. I'm about 1,000 videos into this already, and we still haven't even gotten 1/3 of the way through. It's like college. So we have the wick, which is a gap. We have the consequent encroachment, which is the midpoint of that. Then we have the old high, and then we have the liquidity pool resting above that. Okay, so there's all these levels that we have to watch for. Now, the question you new folks are asking yourself is, okay, well, which one do we watch? You watch the levels independently in relationship to time of the day of the week. And now think about it. Price has ran all the way through on Thursday above this high. I mentioned on Wednesday, as I always remind everybody, that the weekly range generally, unless there's an extremely important, impactful news event on Friday, Thursday's New York session will either make the weekly high or low in respect to the opposite end of the range. That would form normally between Tuesday, London Open. That's a high probability if it's bearish, or if your bias is bearish on the week. Tuesday between 2 o'clock and 4 o'clock in the morning, New York time, okay, that will generally create a 70% likelihood of a high of the week forming. So if you're bearish, Tuesday, 2 o'clock to 4 o'clock in the morning, there's going to be the weekly high forming there, 70% of the time. Now, that is not 100%. It's not 95%. Okay, you still have 30% chance of being wrong. How do you know when it's going to happen? If Monday is consolidated and you're bearish, and then we have a run up ahead of midnight New York time on Tuesday, or London starts to run up on Tuesday between 2 o'clock and 4 o'clock in the morning, and it hits a premium array, bearish order block, something like that, then you know it. But the catalyst is usually Monday has to consolidate. That's how you know that you have a 70% chance that it's going to happen. Now, if Monday and Tuesday goes lower and you're bearish, and Monday leaves its equal highs, or at least a really nice liquidity pool, and just Tuesday just looks like it just ran down to get some liquidity, prior to that run up that you would expect in now Wednesday would be the high of the week between 2 o'clock and 4 o'clock in the morning. Okay, so in the grand spectrum of it all, Monday could start off right from the jump and create the high of the week too. But I'm willing to let that go because I know how to get involved in the market on Tuesday and Wednesday using institutional order flow that would enable me to get in sync with that weekly premise and not necessarily have to be in at or even close to the weekly high on Monday. So Monday, Tuesday, and Wednesday, if we're bearish, we're looking for those types of things. Now, there's other protocols you're going to learn in the mentorship to help you get that way and get in there on the weekly high and low. It's not my aim to do all that teaching here, but just to kind of keep you stimulated and then remind those folks that have stopped thinking about those types of things because we've been talking about fair value gaps and immediate rebalances, all these new things that are coming in the commentaries. Don't lose sight of the things that I gave in terms of foundation, because all these things I'm teaching new, they have to plug into that underlying premise that's formed on the foundational studies in the core content. Remember, that is just core content. It's just a language for us to communicate. Otherwise, these new things I discuss and talk to you, they're going to be too above your understanding and too lofty in terms of conceptual idea for it to mean anything to you without understanding what those 12 months content provide. That's why it takes a lot of time and study. And you're not going to get it the first time you watch. You got to watch it several times. So when we run up there on Thursday above this high and we get into that daily bearish order block and close up the daily volume imbalance, we still have a weekly range, but it doesn't need to get there because now Thursday, time of day, New York session, we ran into an area where it could offer because of day of the week, Thursday. We were expecting it to be bullish, correct? Yes, we've been calling dollar higher. So if we've been calling dollar higher, does that mean that the expansion would be bearish or bullish on the weekly chart? Bullish. We're expecting it to expand throughout the entirety of the week. And it doesn't matter if this thing came all the way down here and stopped. It doesn't change the validity of the model because we're trying to capture movement in here. We know what we're looking for. We know what levels it should reach for. And the fact that it doesn't get to 99.98, it does not indicate or suppose that this model is flawed or that it's broken or that you are wrong in your analysis because it offered opportunity to be long dollars, short foreign currency. I said that we could probably come down into this bullish order block, which is a down closed candle, and we have an imbalance in here. It traded down to that, and we wanted to see its support price if it did that. And that's the same thing we're going through going into this week. Okay, we're going to have that same mindset. We want to see price more or less maintain its ability to stay above 99.10 to 99.20 or 20 institutional. Moving into the hourly chart, we can see those levels here. Again, that's that weekly volume imbalance, the high of that. This is that daily bearish order block and the closing of that daily volume imbalance. Okay, you can see price trades into that. And then this is the old daily high. So the market trades during New York in here. New York and London both are opportunities for it to complete, but the highest probability is on bullish weeks or anticipated bullish weeks. If the market has been going higher, generally there is a 70% likelihood that the high will form in Thursday's New York session. Okay. The only thing again would promote this running higher, it would be a high volatility impact event for Friday. And we've covered a lot of ground on dollar, so this is not something to be too terribly concerned about. And if you went long trying to look for some continuation on here and you took a loss, you will see in here that we have a way to mitigate that. And your loss would be minute. If you try to go long in here, running expected relative equal highs, say you want to try this bullish order block, it trades into it and it gives you a little bit of movement. Yay, I feel good. And it stops you out. Do you get mad? Probably. Do you go back in with revenge? No, you're not Rambo. It drew first blood on you. Okay, you don't want to go back in there trying to even the stakes on it. But now we have the market breaking lower. Okay, and we have this swing low in here. Market breaks there. Market structure breaks because it goes below this low here. Why this low, Michael? Because we have an short-term low, a short-term low, and a lower low in between. So it's the intermediate term. So it breaks that. This is a market structure break. Then we rebalance here. So this is a fair value gap in the form of a SIBI. Sell side imbalance, buy side inefficiency. Market goes up, trades to the bottom of this candles here. And then now, if you took a loss, or if you've been waiting to trade a TGIF trade, which is, thank God it's Friday. No, it's not a Jesus trade. No, it's not a religious trade. It's just an expression that we have in the States. It's been around forever. Thank God it's Friday. That means you worked through the whole week. Now you got the weekend. Well, TGIF is basically we have ran up for the week on dollar. So generally we can see a 30% retracement of the weekly range, between 20 and 30% generally. So we have this set up here. SIBI, forms, fair value gap fills, and then the market runs down to an area of relative equal lows into bullish order block. So this right here is a trade in itself, and that could be your entire model. As strange as it is, I have students in here that only trade now TGIF setups. They're not worried about capturing any move. They're waiting all week long, all week long for range expansion to occur, and then they're just trading the Friday retracements. That's it. Now think about it. A lot of you probably like, I can't do that. I wouldn't do that. Right. But they can. And that's how they use this mentorship. They're like, that's our model. That's what we're going to do. You know, one gentleman and his wife, they sat down and said, you know what? We understand that. That makes a lot of sense. We don't know what the market direction is going to be in the beginning of the week. And even though you may outline it in your commentaries, Michael, we are apprehensive to take that. But if it unfolds and we get a real big move on the week, we know that there's possibly going to be a retracement on Friday. And that's what they do. They just work with that concept, that tactic from my mentorship, and now they have a model. And they don't get a trade every single week. Sometimes they get a loss. But overall, their results have been stellar. They have been pleased with it. Now, to me, I think that is wonderful. It's a wonderful testimony to working out your own approach using the concepts and the theories behind everything that I teach, because it's price delivery. They understood, it resonated with them that Friday, if we have a big up move on the week, there's going to be a retracement. That retracement will be logical to them. Profit taking going into the weekend. They want to trade in that move. Okay. Same thing if it's a bearish week and it trades into Friday and gives a bullish scenario, they will go long and trade a TGIF correction of 20 to 30%. Now, what do I mean by that? All you do is get the high and the low of the week from the beginning of the week to Friday morning at in London, when London starts. And whatever that range is, if you determine what 20% or 30% on a fib level, and that's an easy visual way of seeing it, but all you have to do is do the math on it, get the total range, times that by 0.20, and then subtract that from the high, and subtract 0.30 from the high, and that'll give you your bearish objective when you're looking to sell against the weekly expansion up, when it's a bullish candle on the weekly chart. Trust me, if this is going over your head, I teach TGIF trades in the mentorship. So again, don't get so worried about it. I just do this because there's so many people in different levels of the mentorship, and I have new people coming in. I have a couple months in with students. They're saying, hey, look, I like the content, but I want to know where I'm going with it. There's so much stuff you have to learn. And once you get through it and you're in charter level, you'll start seeing, by going back through it again, the different avenues where you can take to have your own unique model. But I say these things to encourage you, not to confuse you, and I probably have confused some of you, but just in your notes, write down, look up, find information on TGIF trade, or what is the framework for the objectives on the TGIF? What does 20 and 30% look like on a weekly range? And the answers will jump off at you when you go through the content, and then you can go back in your journal and write in what a TGIF trade is, what the parameters are, because I go into great detail, which I'm not going to do now, but I probably could have done it with all that jaw boating I just did, but work for it. Okay, so we have the SIBI filling here, expansion down, relative equal lows, bullish order block, and let's move into a 15-minute time frame. Right in here is that break in market structure. Okay, so market structure breaks, comes back, rebalances to a fair value gap, and look how much time it gives you an opportunity in here. These are 15-minute candles. Okay, so basically almost 2 hours. It gives you an opportunity to go short, and once it breaks, it pulls aggressively away, taking out another short-term low. If your objective is to use an hourly chart and then look for market structure breaks on a 15-minute chart to trade a 5 and or 1 minute setup, this is what it would look like, which is exactly this. This low being broken here is the same thing as this low being broken here. That's the fractal nature of price. If you're right in your underlying premise, bullish or bearish, and where it's going to draw to, that's all you need. That's a setup. That's a model. That's a complete system. The only thing you need to do is add money management. Okay. So we have a fair value gap in here. Same thing. SIBI, sell side imbalance, buy side inefficiency. One single candle down. Market comes back, rebalances, then boom, explodes. Now think about that. Okay, we had a imbalance in the form of a SIBI in here, which gets reduced down to this one singular candle. Look how much opportunity it gave you to get short here. And then you have that same thing that occurred on that hourly chart is occurring here on a 15-minute time frame. And then it comes back up with a fair value gap in the form of a deferred rebalance. Market drops aggressively into the order block here. Now, we have sell side liquidity resting over here, so we could see it trade down there. I want to see it, if it goes below 99.15, 99.10, it needs to do it like a spike and then start coming back and then attack the equal highs. If we just start aggressively going lower, then we might be in for something in terms of a major turn on the dollar. And now I'm going to say this and try not to go into a rant. If you have not been following the coronavirus, okay, or COVID-19 they call it now, and everything that's going along with that, you need to start looking at it, okay, because it's spreading into other countries now, and they're finding also individuals getting it that had no contact with people that were coming from China or ever went to China. So now we're getting different levels of infection. Okay, so I believe, as I mentioned last week, and I'll talk about this when we get into the stocks and bonds portion of this video towards the end. I believe that we have done something significant in the stock market, and I'll talk about that when we get there. But moving into Eurodollar, here is the Eurodollar weekly chart, and this was the BISI, buy side imbalance, sell side inefficiency, fair value gap. That I was looking for that to be filled, and if we were to break lower, this is the other one. I just only have the low highlighted, otherwise it would be this candle's open right here, okay? But to keep your focus on the fact that this is the initial one, and to have another one would just be confusing, at least it is for me. So the blue lines, that's your initial gap that we wanted to see filled, and we got that right here. Beautifully done, beautiful. So I want to see if we get back up into this low. It doesn't need to completely come back all the way up through this down close candle. We might just need to go back into it a little bit and then roll lower. Try to avoid the temptation of picking the bottom. I know it feels like it should be the right thing to do, but avoid it. Even if we are wrong by doing that, the market will prove to us that we're wrong and then offer us the opportunity to get on the other side of the marketplace. There's no reason to fear being wrong in your analysis, especially by following long-term analysis. I mean, look how many months this has been going lower. And if you've been trying to call bottom and all that, it's nuts. So, who knows if we go below the 17 low, 2017 yearly low. Who knows? I don't know that. But I'm not trying to pick a bottom. I'm staying with the narrative, because ultimately the dollar could soar and go way above the dollar mark. If we start seeing some real craziness in this virus coming here, our nation's not ready for something like that. You see all these other nations that I think accept the fact that they can just close up their shops, like in Spain. That's what's going on right now. They're just closing up their doors. They said, okay, everybody's business, close your doors, go home. And they're doing it. That's not going to go too well with McDonald's and Wendy's and all your pizza and cheeseburger joints around here and stores. We as a nation in America, we don't like to be told what to do generally, and the public tends to act like spoiled brats here, because we generally are. We have way too many freedoms here, and then if the government kicks in and says, okay, we have to have a mini martial law. And then this sounds like conspiracy theory. It sounds like it's right out of a movie. It sounds like it's nonsense. It's, oh, Michael, you're going off with some Chicken Little narrative. Well, listen, I told you back in October something was coming. Okay? I mentioned that it has to be something bigger than 9/11 and planes hitting a building. Okay? They have to get the narrative of something to be fearful of. And I can't imagine anything more terrifying than something you can't see, you can't smell, you can't taste it in the air, but yet it could take your life. And it spreads easily. To me, like that's the perfect psychological weapon and also physical threat to people. So whether this was man-made, biological, act of God, whatever, it warrants your attention. And as I mentioned before, if you are not preparing, storing up some food, some medicines, whatever, people are now realizing the medications, doctors are being, I think, told, no, you're not getting any advancements on medication. And also, most of our medicines in the U.S. actually come from China. So I think we probably missed, or you missed, that opportunity to get any kind of medication. You waited too long. Don't do that with water, bottled water. Get food, get non-perishable foods like canned goods, because if we are told to do a shelter in place, that's going to freak people out in the United States. Like if we have to quarantine a city or a town, people aren't prepared for that. They're going to lose their mind. Okay, and the perfect example, my wife, she is in denial. Like she thinks none of this is real, but she's an avid Facebook user. And the things I talk to her about in our conversations, she's like, oh, whatever. And then all of a sudden she sees a video about that very thing on Facebook, and now she wants to talk about it. So she is the definition. And I love my wife. I'm not trying to talk down about my wife. I'm just saying that is a wonderful indicator. Like I said, that's how I called the top in Bitcoin. When she said, are you trading Bitcoin? When it was trading just below 20. So I went right to Twitter. I said, okay, Bitcoin is not going to 20,000. It's going down 6,000. Because my wife now is asking me if I'm trading Bitcoin, and it should be a place for us to buy because it's going up. So if she knows about it, she don't even like it. She thinks this is a video game. If her opinion now about a market or a situation is now inclined her to want to talk about it, then that means everybody knows about it. So in reference to this virus, she's in denial that it ain't nothing to worry with because the flu kills so many people every year, blah, blah, blah. They're making a big deal out of it. But you don't see people walking around in hazmat suits with the flu. You don't see them spraying down airplane luggage and wrapping them in plastic and spraying it with viral treatments. And they're spraying the steps that lead off of planes and things like that. This is something totally different. So devil's advocate for a moment. Maybe it is just a harmless virus that, will make you sick to the degree that like a flu would, and it kills those that are really susceptible to falling ill gravely anyway, if they were to get a regular flu. Okay, I'll grant you that. I'm saying that the reaction in the public is what I'm concerned about. Whether I'm right about it being a bioweapon, which I personally believe it is, I don't have any facts to prove it. I don't have any things to substantiate it. I just look at the evidence where Wuhan, China was. They had a level 4, basically a CDC in that area. And in Canada, you research this as well. Last year or so, Chinese man and wife were basically removed from a Canadian CDC. And now all of a sudden we got this problem. So there's a lot of pieces that need to be put together. And I'm just saying that if there is a basis for, and see, I already went on a rant, didn't I? Sorry, but I got to get it off my chest, because if I don't, I'm going to regret having not said it. If this virus is just a regular old, really bad version of the flu, okay, and maybe people overreacting in terms of treating it or trying to contain it, whatever, it doesn't matter, because if it is, then it is what it is. And, we're going to have to deal with it. But if it isn't that, they're trying to create the situation like it is. So I believe the outcome is being either led to by default, as it would normally and naturally would be in the form of pandemic, panic, fear, and shelter in place, martial law, or it is real, and it's a real threat, And it's really going to force these situations in the United States. And as soon as our economy has to deal with that, forget stocks is over. You will see huge losses in the S&P, Dow, and NASDAQ. Now, I've talked about this, a couple years ago, before Trump was even elected. I said that his last year, if he does anything well, they're going to crash the market because they don't want to have another explanation for why the market crashed outside of some guy, okay, that was a reality TV show guy. He has a track record, and the common consensus is the guy's a failure. All his casinos go bankrupt, blah, blah, blah. When a company goes bankrupt, I'm not trying to defend Trump. I'm just saying that the level of education in the United States is shocking as it relates to business matters. But a business can file bankruptcy and not really technically be broke. It's a way for them to more or less move out of responsibility. Now, you can look at that and say, well, that's irresponsible. It's wrong. It's, not ethical. It's business. It is what it is. And you can't say anything about it. It's just the way it is. I said years ago that I think they're going to crash the market, and they have a perfect a Ponzi scheme that they've created with this stock run is ridiculous. These are levels that don't justify being here. There's no justification for it. None. No stock warrants the levels we're at right now. We're so overvalued, it's ridiculous. But when we did the bank bailout, okay, the Federal Reserve bailed out the big banks, and now the taxpayer has been paying that. But the Federal Reserve wanted basically a payment, for doing so, because there's underlying risk. And I believe they told them to put the money in the stock market, and it keeps getting pushed up and propped up. No matter what happens, any bad news, nope, let's sugarcoat it and send it higher, because they bought equities and securities at the lowest point when everybody was fearful back in the housing crisis. All of that was accumulation. Go back and listen to all my talks about that stuff back then. And now we're living in that moment right now. And I'm not trying to pretend I'm Nostradamus, okay? I'm not some prophet. I'm just saying that this has all the bells and whistles of perfectly engineered. They got a perfect fall guy in the White House right now. And personally, I'm sick of him. I'm sick of him. I'm tired of hearing him talk. I'm tired of hearing him bragging about himself and what he's doing, and he's doing this and he's doing that. I'm sick of it. Okay. Problem is that we don't have another Republican that is as popular as he is, and I'm Republican. So I do not want a Democrat in office. But I believe that we're seeing all of the perfect storm scenarios coming together for the very crash that should have happened years ago. But I think it's going to happen now because they have the perfect excuse for it. They got some guy in here, the lawless one, who thinks he's above the law, the King Trump. Think about it. You have everybody everywhere thinks this guy gets away with everything now. And the punishment, the ultimate punishment, the slap in the face, is the very strength and champion banner that he's been waving since he got in office. Look at the stock market. Look at he don't even trade stocks. But look at the stock market. New highs, new highs, new highs. Trump doesn't make these markets go up and down. That's why you're here. You've learned that. Just like patterns don't make price go up and down. The narrative behind the price movement, okay, that is what makes price go up and down. It's not support and resistance. It's not any of those things. So they can have anybody they want in that White House. None of it has any bearing whatsoever on how these markets are going to turn and gyrate and move up and down. It's the way it is. Okay, and you can give me all the economics 101 crap all you want. I'm in here every single week proving that stuff is nonsense. Absolute nonsense. I have economic majors in here. People that from universities, they're in here. And they're saying this is revolutionary. this is completely opposite to what we're taught and what we're supposed to teach. Yeah, because this is the truth. Think about it. I mean, it's the way it is. It's the animal. That's what we're in. Okay. So anyway, I say all this to say this. We could potentially see a crash, but could is not a definite. So while that is looming on the horizon, I might be wrong. Trump might get reelected and it doesn't happen. Or Trump loses and someone else gets in office and it still doesn't happen. Okay? The point is this. Try to avoid picking bottoms. Try to avoid picking tops. It's a situation that will cause you more frustration and more losses that you're willing to endure. I lost so much trying to do that and don't. And that divergence stuff with indicators, that's what it teaches you. It teaches you to think that you could pick a top in the market and the bottom in the market doing that crap. And no one consistently does that kind of thing. You know, in all the years I've been trading, I have only got one market that I would like to think that I called a top in and actually traded it. Every other instance I tried to do it, I got buried. Okay. They literally smashed me. Okay. And then I would get mad. I'd do it again. And I'd blow the accounts out trying to pick a top because I would get mad. No, it's really going to top now. Oh, it's really going to top now. And then 6 months later, it still kept going up and up and up and up. And that was a pork belly market. So I'm glad in a way they don't trade anymore because it made me angry. I treat them like the yen. All right, so if we lose this level here, this is the next level of imbalance on the upside, and that should fill. So, but it may require a little bit of a bounce in here initially in the week. Now, if we get a raging run above this low, the bearish order block here is the next premium array to manage. Well, not manage, but to look at and consider as a potential upside. All right, but I don't think that's required at this point. Let's move into a daily time frame. And look how nice that is. Now, when we get down to lower time frames, as I mentioned on Twitter, I was off by 3 pipettes, okay, on the forex.com. So when you look at these charts, I have it printed out in such a way where you can see the feed. So it's forex.com, the euro dollar, okay, and obviously it's TradingView. But look at the reaction there, okay. The things I teach you in a lower time frame, and everyone gets all googly-eyed about on Twitter, like, wow, this is really neat, it's so precise, blah blah blah. And it is the same thing we're doing now on weekly charts. Okay, so again, don't think that you're not learning how to trade long-term position trading because I'm teaching you with a 15-minute time frame chart. That's the myopic perspective coming in, especially if you've tried doing that higher level style of trading and you know that you feel an affinity for it. I get so many emails in the mentorship from people that say, look, you spend too much time on these lower time frames. Please talk about the higher time frame more. I do every single time. We're looking at higher time frame charts right now. I tell you where it's going, what it's likely to do, reaching for it, okay? And you may not be able to get in at this very point where we said it was going to go lower the very next week, boom, and it did. But now, because you know short-term trading and day trading and scalping, you can get into these individual candles in any one of the respective trading sessions for that day to get in sync with the larger time frame move after you've missed the ideal entry point. Oh, now it's starting to make sense. That's why I teach a comprehensive, all-encompassing approach. I don't try to just force you into a mold. The people that are charter level, they see with a different level of clarity than you have right now while you're going through the 12 months content, because they have a different array of choices to go into attacking a particular market. They don't have to have the absolute, perfect entry. They can see that happen, and then the market starts to go over, okay, well, now I know it's going to be reaching for liquidity over here, so I can get in short on this day or this day, and I know I can be in sync with that move and leave a piece on for maybe getting down to this level of 107775, which is what that level is, but it only went down to 10778. So 3 pipettes, not even a half of a pip. So If you look at the other data feeds on Eurodollar on TradingView, I think they offer Oanda, they offer Saxo, and they offer something ICE. And I shared some of them on Twitter the other day. But one of them, they did give us our price. But I'm only sticking with Forex.com because that's the data feed that I promised we would all focus on. But you can see that is really respectful of the level in terms of accuracy for a weekly chart to only be off by 3 pipettes. Like, that's insane. If I would have been told that in the beginning of trading that you could do things like that, like, I would have never believed it. And now you're seeing the evidence of it. All right, so anyway, we're going to watch this low over here because that is a breaker. We have highs, low, and higher high. So this becomes a point of mitigation. Does it need to go all the way up to there? I don't know that. Okay, that I don't know. But if it does start to expand up there, I'm going to be watching these levels here, the low and the close of that candle. Not this low, this low. It's the down close candle that makes the breaker, not this up close candle. All right, so into the hourly chart. So here's the hourly chart. We have a swing high here. Price managed to get up to that, sweep above that. And we had a nice little optimal trade entry here during the New York session. BISI, buy side and bounce, sell side inefficiency. Then expansion on the upside, attacking a pool of liquidity. Okay, you could have used this high here, not necessarily this one. And if we go higher, I'm watching this right here, this fair value gap and the low of this up close candle, because it might need to get up there to trade to that as a bearish order block, which would essentially run a deeper form of buy side liquidity above these relative equal highs. Relative, these ain't relative, like my son Caleb would say. Dad, they're not equal highs. Right, they're relative. In relative terms, this high is really close to this high. If we zoom out, everything else in squiggly price action, these two highs would look more relative than they are on this zoomed in perspective. And besides, that's where liquidity rests above old highs in the form of buy side. Moving into a 15-minute time frame, we can see our New York setup here. Displacement, retracement, rebalance, rebalances to a bullish order block, and does it again here inside the kill zone. So yes, it's ahead of the kill zone. If you use limit orders to get in here, this would have filled you ahead of the kill zone. If you're watching diligently in the kill zone, price drops down into the bullish order block, fair value gap, relative equal highs. Then we have the levels outlined, as I mentioned, in the higher time frame charts before moving into the 15-minute time frame. You can see the respective levels here. Beautiful run here. We have another opportunity to get in here on a BISI. Buy side imbalance, sell side inefficiency in the form of fair value gap. Bullish order block, the down close candle. Fills in this single up candle. We have a movement down. So this area here is rebalanced, and now you're free to run higher. Takes off. Why is this move happening? Why is this so predictable? We're bearish Eurodollar, Michael. You can't say this is a trade that we would have taken because you've been saying that Euro is going to go down to 0.775 and it didn't get down there. Look, it got real close and you failed. Well, how toxic is that? That's how you know the people in here, okay, are going to learn this or they're not. I mentioned earlier in the video TGIF trade scenario. Okay, if we have a up move expected for the week, and it does, and it delivers all through the entire week, Friday's going to have a high degree of profit taking. It's going to form a retracement. The weekly range, you're going to get a 20 to 30% retracement on Friday. Well, you're seeing that here. Okay, so if we get this scenario where the market structure broke on the dollar, and then we have this here, this scenario, then we can anticipate the run on Euro, and we can anticipate the run on GBP. Moving into a 5-minute chart, look at the beautiful fair value gap here and bullish order block right there. And an extreme volatility on the upside, attacking points of liquidity. Because this is where stops would have been trailed all week long as it went lower, lower, lower. London gave us a tip. Boom. They're going to ready to make a TGIF trade. It's going to be a retracement into Friday of the weekly range. From the weekly highest high and the lowest low that's formed prior to the New York session in on Friday, that's your scenario. And you're going to look for a 20 to 30% retracement into the top and low, or high and low of the weekly range when you've been bearish. When you're looking at a bullish market, you're going to be looking for the highest high and the lowest low, and then a 20 to 30% decline or retracement from its high. Okay, so that's the TGIF trade, or the characteristics of that trade. Okay, finally moving into GBP. Here is our weekly chart. And as I mentioned last time and the time before that, I don't know what this pair is doing. It's really, it's completely confusing me. I think that it will want to go down into these relative equal lows, as we'll see on the daily time frame. But we've taken highs out here, we've taken lows out here, and we didn't take out this, and we haven't gone above the rejection block. So we're just going back and forth in here. That makes trading very difficult. You have to be a scalper, and I don't want to be even scalping in this kind of market. So daily chart, let's see what we got. There's the relative equal lows. I mentioned Wednesday that we would potentially look for that to be ran out. Where we are right now on Friday, we came back up and rebalanced this fair value gap. So it'll be interesting to see if we roll over on Sunday. Maybe we gap down and come back up, fill the gap, catapult, and then shoot it lower, attacking these relative equal lows. If we accelerate through that and we get, again, the dollar to resume going higher, we would look for a run below here. All of this is balanced. So our eye would have to go to order block, consequent encroachment of the tail here for that gap, and then we have the actual fair value gap. I think that if we get a break below here and here, forget anything in here, just look right there, because that's where it would go to. But it has to break this low to even consider that, okay? And again, I have been not strong in cable, and I mentioned this. It's so heavily manipulated right now because of Brexit. I just can't stress it enough. Do not force trades in this. Don't trade with live funds. Don't do any of that stuff with this pair, because it can do something. Look, I already told you, this is a perfect scenario for Black Swan. Black Swan is an event that just comes out of nowhere. No one saw it coming, and you can get wiped out, blown out, like you can't even imagine. Like, it's very, very bad. So just know that that's what this pair is indicating to me. I see this in the chart, and if it goes down here and hits that, beautiful. I'll probably have about a 98% likelihood of not being in that trade, and I'm okay. I'm electing to stay on the sidelines with this pair because I think it's going to hurt me if I get in it. So I am obligated to talk about it because it's one of the pairs I do follow actively, and this really fits our mentorship model as far as what I've created for this mentorship. And I don't want to take suggestions from people, and I know there's a lot of you say, can you start talking about this pair? I did that the first year, folks. Please don't do that. I'm only going to talk about the things that are important to me in terms of teaching and staying on schedule, because I have a schedule I'm following. You don't see it, but I have a schedule that I have to stay on top of. And then we'll be moving into certain things like we've been talking about, index futures and bonds. We haven't been talking about that for 3 years. Okay, so now we're into that. And as we get into spring, we're going to be segueing into commodities in addition to that. Not forgetting Forex, okay, but we have to prove that these things are diverse, not just limited to just the Forex pairs and dollar index. All right, so hourly chart. Here we have a low. The market, once we get this low here, this is the break in market structure. As I mentioned in the Wednesday review, the market breaks lower, runs sell-side liquidity and relative equal lows, and the market makes a run for that. And then, as I mentioned on one of the followers on Twitter, they asked if there's a mitigation block up in here. I said, no, it's not mitigation. It's going to, and it rallied up aggressively. And then we do have a fair value gap in here. It did trade up into that. I'm putting the eyeball here because this is mitigation. Okay, so if we trade up into this level like this, I want to see it roll over. If it pushes through that, then we're probably going to make a run above these equal highs. Okay, so there's your catalyst. Either it needs to drop immediately going into the week, or if we trade higher than this down close candle on your hourly chart, so whatever that price is, 130, then we're probably going to go to 130.80, 130.70, okay, on cable. And there's our 15-minute time frame. You can see the setup for New York here after running the sell side liquidity. And here is your displacement ahead of New York. The retracement lower, it's ahead of New York. So if you use limit orders, you would be filled here ahead of the New York kill zone. Then we have another measure of displacement. Now, looking at this run here and then a run here and then retracing, if you're new to what I teach, that would probably feel uncomfortable because you're going to be looking at indicators and they're going to be flashing bearish divergences like crazy here. Bullish order block. Extend that out in time during the New York kill zone between these goalposts, okay? I don't like football, but think of it like that. In this area here, anytime we touch this order block and close in this one single candle up, when it goes down to that black candle again, anytime it touches that, it's a buy. And you aim for the liquidity pool, as I mentioned on the hourly chart. You can see that running here. Okay, so again, this is that consistency. Every single day, this pattern exists in New York. Find a liquidity pool, get in sync with the direction. What's the directional bias? Well, we've been bearish on foreign currency, bullish on dollar. But the dollar's been bullish all week. Now Thursday, we get a retracement into Friday. So TGIF scenario. So we may be bullish on the week on the dollar, but TGIF conditions on Friday warrant a reversal market condition. So we can see that London tipped us off again, retraced, displacement again, find the liquidity. Where are we going to reach for? Above a hourly liquidity pool. Wait for a retracement lower into a bullish order block, fair value gap, overlap, optimal trade entry, not because it's a patented inner circle trader copyright fib levels. I didn't copyright fib levels, folks. The optimal trade entry is the order flow and PD array that's below 50%. That's what makes the trade optimal, not 62 to 79%. That's just a really neat spot that is widely followed. I didn't create that, but the understanding of how using fair value and premium to discount, that is mine. And I only use the fib to illustrate what defines premium to discount. That's all it is, okay? That part I did copyright, but I did not copyright 62% and 70.5 level fibs and 79% retracement level. That's not what I did. That was around way longer than me. So this is the scenario. This is what it looks like using the underlying premise that if TGIF conditions are there, we should see a retracement of the weekly range on Friday at New York and look for a 20 to 30% retracement on the weekly range. Do that yourself and see what you get with in response to where these levels went to, or price went to those levels. Okay. All right. So wrapping this one up, it's been a long-winded one. I apologize. Not really. Trading the T-bonds, we want to go back and refer to what I gave you the last two sessions looking at these markets. I mentioned on the Wednesday midweek review, I said that we're seeing a lot of accumulation on bonds, failing to make lower lows when the S&P was making higher highs. That's problematic for stocks, and it's bullish, extremely bullish for bonds. As I tweeted this week, I said bonds are going higher, smiley face, and I reminded everybody, bonds are my baby. This is the market. If you tell me I have to stop trading Forex, you got to pick something else. I'm going to